In this video, I want to talk about 3 costly mistakes most retail investors make, and I will tell you how to avoid them. This video is for you if you are a retail investor and you manage your own portfolio. And if you avoid these 3 mistakes, I guarantee that you will make much more money. I've done these mistakes in the past and I don't recommend you do this at all. So the goal of this video is to give you a lot of value, and it will be a short video and that will be really fun. So welcome. In case this is your first video from this YouTube channel, my name is Christophe Nour. I've been investing in the stock market for almost a decade now. This channel is for retail investors, and over the past decade of investment, I have generated a performance of 25% per year. And in the first year of investing, I've done these mistakes. So I know that you should avoid them because, I mean, that's quite important. You want to capitalize and compound your wealth. The first mistake, pretty simple, is to rush into fads like the quantum computing stocks. I don't know if you remember, but a few weeks ago, everybody was talking about new stocks, quantum computing stocks, because Google had developed a new Willow quantum chip that would disrupt Bitcoin. You have a lot of news, press releases, and now nobody's talking about quantum computing stocks. Yeah, this was the definition of a fad. A lot of people talk about it for a few months, a few weeks, even a few days that can be very short, and then people forget. And now we move on to the trade war. And then we will move on and we will go to another topic. And we've had this phenomenon of having fads for decades, for centuries. If you look back, I mean, a few years ago, you had the EV, electric vehicle. Everybody wanted to invest in EVs. I remember when I was working in Paris, some companies pitched the investment thesis with nice presentations, nice slides, graphs that went up and to the right, projection, forecasts. We expect to be profitable. It turns out that all of them are bankrupt now. So, yep, this is the definition of hype. You have a tiny growth and you expect the growth to become phenomenal over the coming decade. It turns out that this is not how the world is moving. You need to be robust, resilient. Don't forecast stuff that is very recent. This is the definition of a fad. For example, for quantum computing stocks, these stocks have been bad investments for the past decade. And now we have one big news and all these stocks tripled. And you know what? If they don't deliver, they will go down and these stocks will go down. So in 2021, you had the electric vehicle. I was once pitched a hydrogen car investment, went bankrupt. I think the company's name was Helium. I mean, that's a great vision they have, but at the end of the day, if you are a public company, you need some profitability. So yeah, and in 2018, you had the same thing with, I don't know if I can say it on YouTube, the weed companies that are selling these kind of products. Because of legalization in Canada, maybe in the US, maybe in Europe, you will have some legalization of this. I mean, yeah, if this is legal to smoke, maybe some businesses will make money. It turns out that all these businesses are bad. You don't make a lot of money. You have a lot of costs. You don't have a lot of demand. You depend on the regulation. Same thing with the vegetal meat. You had Beyond Meat that was quite famous during COVID. All these fake meat companies. I've never tried it. I've never tasted one, so I have no clear opinion on if this is good or not for the taste. But for the business model, I knew that it was a bad business model. I mean, you can talk about whatever you want, economies of scale or cost advantage, first mover advantage. Well, if you are burning cash every year, it's much likely that you will continue to burn cash. Most of the companies that are bad like this stay bad. You have a few exceptions, Uber, Spotify, Netflix, but we are talking about the top 1%. The remaining 99% are bad. So I see a lot of people on Twitter, YouTube, young investors, beginners in the stock market that have been investing for a few months. They rush into fads and they say, I'm a genius. This is the next big thing. Okay, it snaps immediately and you think that you will make a lot of money, but this is harder than expected and you will stress a lot. The stress is not worth it. If you want to be profitable in the long term, you have to follow the Warren Buffett way of investing. I mean, you buy a good business and you expect the price to go up because the business is improving. A lot of money, a lot of cash. I mean, that's more revenue, more earnings. If you rush into fads, you will have a lot of stress and most likely you will lose money. So avoid this one. And how do you fix this mistake? You, how do you say it? You pay attention to what are the news and if these stocks are profitable or not, if these companies are profitable or not. You filter out the bad companies in your analysis and you only invest in profitable companies that have a long track record of being growing profitably. Basically, this is exactly how to fix that. Now, let's talk about the second mistake. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. The second mistake is too much diversification. Okay, what is the good amount of stocks you need in your portfolio? Do you need 5 stocks? Do you need 50 stocks? Maybe in the middle, 20, 25? Some beginners say that, yeah, maybe I'm not an expert, so I will diversify my portfolio. I will buy a little bit of this, and then Microsoft, and then some Lens, and then some industrials, and then I will buy John Deere, and then some Caterpillar, and then some quantum computing stocks. I will buy something, and then some Japan, and then some China. And at the end, if you buy too much of everything, you dilute your returns. And if you follow 10 companies, imagine you have 10 companies in your portfolio, it will take some time for you to monitor these companies over time. You know, every quarter you have the quarterly results, quarterly reports. So you have to monitor what your companies are doing. Is it going good or bad? Okay, do you have to sell more, buy more, this kind of stuff. So for 10 companies, it takes a lot of time to monitor your investments. Imagine that you have 20 companies now. It will take a lot of time to monitor 20 companies. Imagine you have 50 companies now. It's impossible. Yeah, spoiler, it's impossible to monitor closely 50 companies. Either you are a genius or lucky because it's impossible. It will take too much time. So you have some fund managers that have 200 names, 300 names. This is their job. And if you are watching this video, you are a retail investor. You are not a professional investor. So you will not have the information to monitor and to follow up with hundreds of stocks. And I see too many retail investors, too many beginners diversifying away. They don't focus on their edge. Most likely, you are a retail investor. You are good at something. You have a passion for golf, for surfing. You know more about this industry than most people. If you are a software engineer, you know more about this industry than 99% of people. Please focus on your edge. Focus and invest only with companies inside your circle of competence. This is how to fix this problem. You don't diversify too much and you focus on key areas where you have some knowledge, competency, expertise. This is how you fix this mistake. Having too much diversification can lead to what Peter Lynch calls diversification, is where you have too much stocks of a bit of everything, and it turns out that you have some winners, but you have some losers. So at the end of the day, if you own too many stocks, it's like you own a basket of 200 companies. It's like if you bought an index. You will have the same performance as an index. You will have the same performance as the S&P 500. And if you want the same performance as the S&P 500, why do you do stock picking? Why do you pick specific stocks? Focus on your assets. Focus on your key expertise on companies inside your circle of competence. Where you have an edge, you know it's a great business, growing profitably, a lot of cash flow. They don't have debt, they have a lot of cash. I mean, when you are sure of your investments, that's where you make a lot of money. So, second mistake, too much diversification, focus on your edge. And the third mistake is to invest in commodities. I see too many people, beginners, saying that commodities companies, oil and gas stocks, oil and gas companies are cheap. Commodity oil and gas sector is very cyclical. You have ups and downs. And I've known it because I have invested in the past in oil companies, commodities. You have zinc, you have copper, you have silver, you have gold, you have oil, you have gas, you have a little bit of everything. But investing in commodities, I would say, is for professional. It's a little bit too hard for the retail investor, and it will lead to a lot of stress, a lot of anxiety. You will be frustrated, and you will buy at the wrong time, sell at the wrong time. It's not worth it. You have in the stock market, you have 50,000 companies, 50,000 stocks. You have the choice. Why do you choose the commodities? And I mean, most investment in commodities are bad. This is a capital intensive industry. You have a lot of costs. The guidance for these companies are very difficult to follow. And if you want to invest in an oil company, for example, the commodity, they don't control it. The oil price, nobody can control it. I mean, the OPEP can control it. It's a matter of supply and demand. With the US, if they drill a lot of oil in the US, in the Permian Basin, they can be the biggest producer. You have Russia, you have Saudi Arabia. You have geopolitical tensions that will influence the stock price, because geopolitical tensions will influence the price of oil, that will influence the revenue of an oil and gas company, and that will influence the earnings per share. And if the earnings per share is dropping, your stock will be dropping. So at the end of the day, these companies don't really control their stock price. It's very hard for them. I mean, I don't say it's impossible, but I would say it's much harder than, say, Nike, Starbucks, Chipotle, Google, these kind of stocks. So these are three costly mistakes that I see a lot when it comes to beginners or even most retail investors. They focus on these three mistakes and lose a lot of time, lose a lot of hair, they have a lot of anxiety, they are stressed, they are pissed off, and then they complain. But please avoid these three mistakes, and I guarantee that if you stay away from these three elements, you will make much more money. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.